Bank of England is likely to raise interest rates towards the end of the 2-year period, says Gregor Irwin, Global Counsel. Since 2009, the Monetary Policy Committee have left interest rates at 0.5%. Can you see them changing this decision after the referendum, and to what extent?
Well, we had a meeting of the Monetary Policy Committee meeting today, and its baseline judgment, which is conditioned on the UK voting to stay in the EU, is that weakening drags on inflation from falling energy and food prices will mean that inflation is likely to edge up back towards targets over the next couple of years, and that's despite the weaker outlook for growth. So that would mean that the Bank of England is likely to raise interest rates towards the end of that 2-year forecast period. What the MPC also said today is that if the UK votes to leave, there would be two material impacts on the macroeconomic outlook. One is to further dampen consumption and investment as households and firms respond to increased uncertainty by paring back on spending. And the other is to push up inflation, perhaps quite a bit, if there's a sharp fall in the value of sterling. Now, the MPC has noted that both of these effects will push in opposite directions. So its challenge is to weigh one against the other when considering what it means for the future path of interest rates. And that judgment is really about the durability of these effects as well as their severity. So the answer is we won't know until we see exactly what sort of macroeconomic impact a vote to leave the EU has. But either way, we're probably talking about some time before interest rates start to go back up.
The UK inflation rate currently stands at a 15-month high due to rising costs in housing and utilities, as well as the service sector. Is the delay in spending decisions and depressed growth just due to the EU referendum, or are there other reasons for the current outlook of the British economy?
The referendum is clearly one factor, but of course there are other factors at play. One of the most important, which I've noted already, is the large drag on inflation that's coming from energy and food prices. It's also true that the international outlook has been more subdued and more uncertain since the turn of the year, and that's also likely to be holding back confidence in the UK itself. So yes, while inflation may be higher than it has been, it's still low, and most importantly, it's lower than the MPC expected it to be a year ago. So the combination of these international factors means that the picture's not quite as straightforward as you might expect.
In your publication for the Global Counsel, 5 Ways the UK Deal Would Change the EU, you discuss David Cameron's reasoning towards currency discrimination. Is the issue of the pound to the euro currently affecting monetary policy, and how?
The measures that were agreed by the European Council against currency discrimination are very important for the financial services sector in the UK. The European Central Bank's location policy, and in particular its attempt to move euro clearing inside the euro area, has been a major point of contention. Now, the European Court of Justice has actually ruled against that, saying it's not consistent with the single market. But the part of the deal struck by David Cameron that you're referring to is an attempt to ensure that there's no doubt whatsoever that in future there will not be discrimination against anyone based on currency if the UK votes to stay inside the EU. Now, these issues are quite separate from monetary policy. Of course, the sterling-euro exchange rate matters a great deal for monetary policy, just as the sterling-dollar relationship matters. That won't change whether the UK is in or out of the EU.
David Cameron's decision for a referendum on the UK's membership in the EU has allowed him scope to renegotiate the EU's policy towards British sovereignty and economic governance. If the UK remains in the EU, how are these renegotiations going to affect interest and inflation rates?
Well, I would say it's very hard to see any direct link between the sovereignty and economic governance provisions and interest rates and inflation. The sovereignty provisions are about ensuring that national parliaments are not ignored when the EU takes decisions, and the economic governance provisions are intended to ensure that the interests of non-euro countries are not ignored by euro countries, particularly as in future they will have enough votes to push through decisions by a qualified majority vote. Now, that is very important for future legislation affecting the single market, and it will be particularly important in sectors such as financial services. But it won't impact in any way on the flexibility that the Bank of England has to set interest rates, or indeed on the outlook for inflation. The Bank of England has complete flexibility as it is, and the outlook for inflation is primarily a function of monetary conditions in the UK.
Thank you very much to our guest, Gregor Irwin, Chief Economist at the Global Counsel. Stay tuned for Everything Forex with Dukascopy TV and be sure to check back tomorrow for more. Bye for now.